A trader who enters the market without first defining risk has already placed himself at the mercy of emotion. Risk is not a technical detail to be handled later, nor is it a defensive afterthought. It is the foundation upon which every decision must stand. Before a trade exists, before an entry is justified, before profit is even imagined, risk must be known, accepted, and respected. This single discipline separates those who survive from those who repeatedly destroy their accounts while blaming the market. Most traders reverse this order. They begin with desire. They see a move, imagine profit, calculate potential gain, and only then consider what might go wrong. By that point, the mind is already invested. Once hope enters the process, objectivity leaves it. Stops become flexible, size becomes negotiable, and losses are tolerated longer than planned. The trade no longer follows rules, it follows emotion. This is how small losses become large ones, not because the market moved, but because the trader surrendered control. Defining risk means knowing, in advance, the exact amount of capital that can be lost without damaging confidence or survival. It is not about being comfortable with loss. Loss is never comfortable. It is about being prepared for it. A predefined loss removes surprise, and surprise is what fuels panic. When the outcome is already accepted, execution becomes calm. The trader is no longer reacting. He is simply following a plan. Risk also dictates position size, and position size dictates emotional stability. A trade that is too large will dominate the trader's thinking, even if the setup is sound. Every tick will feel threatening. Every pause will feel dangerous. The trader will watch price instead of structure, fear instead of logic. By contrast, a properly sized trade allows the trader to think clearly. He can observe, wait, and act without urgency. The market does not feel personal because exposure is controlled. Many traders believe confidence justifies larger risk. This belief is fatal. Confidence does not reduce uncertainty. Clean charts still fail, strong ideas still break. The market does not reward belief. It responds only to price. A disciplined trader understands that certainty is an illusion and treats every trade as vulnerable. He does not need to be right. He needs to be protected. Risk defined before entry also creates consistency. When losses are uniform and manageable, no single trade has the power to destabilize the account or the mind. Recovery becomes possible. Learning becomes continuous. Without defined risk, each loss feels unique and catastrophic, leading to revenge trading or paralysis. The market does not punish traders for being wrong. It punishes them for being careless. Those who define risk before every trade remove carelessness from the process. They accept loss as part of the business and deny it the power to escalate. This is not caution. It is professionalism, and without it, no strategy, no insight, and no experience will ever be enough. Position size is the silent force that decides a trader's fate, long before the outcome of any single trade is known. Most traders believe their success or failure is determined by entries and exits, but this belief misses the deeper truth. Two traders can take the same trade at the same price, with the same stop and target, and one will survive while the other will eventually collapse. The difference is not intelligence or timing, it is size. Position size determines how much emotional pressure a trader can withstand and how much damage a mistake can cause. When position size is too large, logic becomes fragile. The trader may begin with a clear plan, but the moment price moves against him, the weight of exposure takes over. Every fluctuation feels threatening. Every pause feels like danger. The mind shifts from execution to self-preservation. At that point, rules no longer matter. Stops are moved, exits are delayed, and losses are justified instead of accepted. The market has not changed. The trader has. This is how accounts are damaged not by bad trades but by oversized ones. A properly sized position does something powerful. It keeps the trader rational. When the risk is small and predefined, the outcome of a single trade loses importance. The trader can observe price behavior instead of reacting to fear. He can allow structure to work without interference. Losses are processed as information, not as threats. This emotional neutrality is impossible when size is excessive. No mindset can overcome too much exposure. Many traders increase size when they feel confident. This is one of the most dangerous habits in trading. Confidence does not reduce uncertainty. Markets remain uncertain regardless of how clear a setup appears. Clean trends still fail. Strong breakouts still reverse. When traders size up based on belief, they are betting on certainty that does not exist. Eventually, the market reminds them of this reality, and the loss is amplified by size. Survival in trading is not about avoiding low SSEs. It is about ensuring that no single loss can cause irreversible damage. Position sizing is the mechanism that enforces this rule. Small, controlled losses preserve capital and mental clarity. Large losses destroy both. Once confidence is damaged, decision-making deteriorates. The trader begins to hesitate, chase, or overtrade, not because the strategy stopped working, but because the mind is no longer stable. Consistent position sizing also creates consistency in results. When risk remains uniform, drawdowns remain manageable. Recovery becomes mathematical instead of emotional. The trader does not need to win immediately to survive. He needs only to avoid destruction. This is how longevity is built. Most traders focus on how much they can make. Professionals focus on how much they can lose. Position size is where that discipline becomes real. It enforces humility. It respects uncertainty. It protects survival. Without proper sizing, even the best ideas eventually fail. With it, even average ideas can compound over time. Most traders believe that more activity leads to more opportunity, but in reality, excessive trading is one of the fastest paths to inconsistency. The market is always moving, and this constant motion creates the illusion that action is required. For the undisciplined trader, doing nothing feels like falling behind. Silence on the screen creates discomfort, and that discomfort demands relief. The easiest relief is a trade. This is how patience breaks, not because the trader lacks knowledge, but because he cannot tolerate stillness. The ability to wait is a skill built through discipline, not through hope. Waiting means accepting that most price movie NT is irrelevant. It means understanding that opportunity does not appear on every candle or every session. High-quality trades are rare by nature. They require alignment, structure, and context. The trader who cannot wait settles for less. Over time, this habit erodes expectancy. Small edges disappear when diluted by low-quality decisions. Impatience often disguises itself as confidence. Traders convince themselves that they are being decisive, aggressive, or proactive. In truth, they are avoiding the discomfort of uncertainty. The market does not reward boldness. It rewards precision. Precision requires selectivity, and selectivity requires waiting. The trader who enters early feels smart until price proves him wrong. The trader who waits feels late until probability proves him right. Patience also protects mental capital. Every trade demands focus, emotional energy, and decision-making capacity. When a trader overtrades, he exhausts himself long before the market offers true opportunity. Fatigue lowers standards. Lower standards invite mistakes. These mistakes then justify even more activity in an attempt to recover. This cycle continues until discipline collapses entirely. Waiting also strengthens conviction. When a trader waits for conditions to fully align, execution becomes effortless. There is no debate, no hesitation, no internal conflict. The trade either meets the criteria or it does not. This clarity reduces emotional attachment. The trader is not hoping for a move. He is responding to evidence. This is a fundamentally different psychological state from chasing price. Many traders fear missing out more than they fear losing money. This fear drives them into trades they would normally reject. Over time, missed opportunities feel larger than losses, even though losses are what damage accounts. The patient trader understands that missed trades cost nothing. Bad trades cost capital and confidence. Opportunity will return. Capital may not. The market does not reward speed. It rewards timing. Those who wait allow probability to work in their favor. Those who rush attempt to force outcomes that cannot be forced. Waiting is not weakness, it is control. And control is what separates professionals from gamblers in the long run. Emotion is the unseen hand that guides most trading decisions. Even when traders believe they are acting logically, fear, hope, frustration, and ego do not announce themselves clearly. They disguise themselves as analysis, intuition, or confidence. A trader may believe he is following a plan, but if emotion is in control, the plan exists only in appearance. This is why so many traders know what they should do and still do the opposite when money is at risk. Fear is usually the first emotion to take control. It appears as hesitation, early exits, or refusal to take valid trades. The trader sees the setup, understands the logic, and still freezes. Past losses whisper warnings. The mind begins to imagine pain before it occurs. To avoid that pain, the trader exits too soon or avoids entry entirely. Over time, this creates inconsistency. Wins are cut short, losses are taken fully, and confidence slowly erodes. Hope is more dangerous because it feels positive. Hope convinces traders to hold losing positions longer than planned. It encourages excuses and justifications. Structure breaks, but hope insists it will return. Stops are moved, rules are bent, and discipline is postponed. Hope replaces responsibility. The trader is no longer managing risk. He is waiting to be rescued by the market. This rarely ends well. Frustration builds when results do not match effort. The trader feels he deserves success because he studies, watches charts, and spends time in the market. When outcomes disappoint, frustration demands action. This leads to revenge trading, increased size, or impulsive entries. The trader is no longer responding to opportunity. He is reacting to emotion. Losses compound quickly in this state because decisions are made to relieve emotional pressure, not to follow probability. Ego is subtle but persistent. It appears as the need to be right, to predict, or to prove intelligence. Ego resists stops because being stopped out feels like failure. Ego encourages traders to argue with the market instead of accepting its verdict. The market does not respond to ego. It responds only to price. A trader who cannot accept being wrong cannot remain disciplined for long. Emotional control does not mean eliminating emotion. That is impossible. It means preventing emotion from influencing execution. This is achieved through predefined rules, consistent risk, and limited exposure. When decisions are made before the trade, emotion has less power during the trade. Structure replaces impulse. Process replaces reaction. The trader who masters emotional control does not feel fearless. He feels prepared. Losses do not shock him because they were anticipated. Wins do not intoxicate him because they were planned. He operates within boundaries that protect both capital and clarity. Most traders never react state because they underestimate the damage emotion causes. They look for better strategies when what they need is better control. Without emotional discipline, even the best methods collapse under pressure. Consistency in trading is not the result of intelligence, creativity, or constant innovation. It is the outcome of restraint, applied repeatedly over time. Most traders believe consistency comes from finding the perfect strategy, the ideal indicator, or the right combination of tools. When results fluctuate, they assume the method is flawed and begin searching for something new. This cycle of constant change prevents probability from ever working in their favor. Consistency cannot emerge from chaos. Repetition is the foundation of stable results. A trader must execute the same process again and again under varying market conditions. This repetition builds familiarity. Familiarity reduces fear. When outcomes become familiar, they lose their emotional charge. Losses no longer feel catastrophic. Wins no longer feel intoxicating. The trader remains balanced. Without repetition, every trade feels unique, and uniqueness invites emotional reaction. Restraint is what makes repetition possible. Without restraint, a trader constantly adjusts, interferes, and overrides rules. He trades when conditions are not met. He changes size based on mood. He exits early out of fear or holds too long out of hope. These small deviations seem harmless in isolation, but over time they destroy consistency. The trader is no longer following a process. He is improvising. Consistency also requires acceptance of imperfection. No strategy wins all the time. Drawdowns are not a sign of failure. They are a feature of trading. The inconsistent trader reacts to drawdowns emotionally, attempting to avoid them through over-optimization or aggressive behavior. The consistent trader accepts drawdowns as part of the business and continues executing the same plan. This acceptance stabilizes behavior. Many traders confuse activity with progress. They believe doing more will produce better results. In reality, doing less but doing it correctly is far more powerful. Selective execution reduces mistakes. Fewer trades with higher quality allow probability to express itself. Consistency emerges not from effort, but from correct effort applied patiently. Discipline is often discussed but rarely practiced. True discipline means following rules even when they feel uncomfortable or boring. It means resisting the urge to intervene. It means trusting the process over impulse. This trust is built through repetition and restraint, not through hope. The market rewards those who can behave consistently under pressure. Pressure reveals character. It exposes whether rules are real or merely theoretical. The trader who remains disciplined during losing streaks and winning streaks alike develops stability. This stability compounds over time into reliable performance. Consistency is not dramatic. It is quiet. It does not produce excitement or stories of sudden fortune. It produces steady growth and long-term survival. Most traders abandon this path because it lacks excitement. They want stimulation. The market rewards professionalism. Those who choose restraint over excitement gradually separate themselves from the crowd and build results that endure. Survival is the first and most overlooked objective in trading. Most traders enter the market focused on profit, performance, and outcome, but none of those things matter if survival is compromised. The market does not reward ambition without endurance. A trader who cannot stay in the game long enough will never allow probability to work, no matter how skilled or intelligent he may be. Survival is not achieved through prediction. It is achieved through restraint. Every decision in trading either supports survival or threatens it. Overexposure, impatience, emotional trading, and inconsistency all shorten a trader's lifespan. These behaviors often feel justified in the moment, especially after a series of losses or during a strong trend. The trader believes he must recover quickly or capitalize aggressively. In reality, these impulses accelerate destruction. The market does not forgive desperation. Longevity in trading is built by avoiding irreversible damage. Small losses are recoverable. Large losses alter behavior, confidence, and perception. Once confidence is damaged, execution deteriorates. The trader begins to hesitate, overtrade, or abandon rules. This creates a downward spiral that has nothing to do with strategy and everything to do with survival being violated. Those who protect survival protect clarity. Survival also requires respecting uncertainty. No market condition guarantees success. Trends end. Ranges break. Volatility shifts. The trader who assumes permanence is eventually surprised. The trader who assumes uncertainty is prepared. This mindset keeps risk small and expectations realistic. Preparation replaces hope. Structure replaces belief. Capital is not just financial, it is psychological. Capital determines how well a trader can follow rules under stress. Every emotional decision drains this capital. When mental capital is exhausted, even simple decisions become difficult. The trader begins to seek relief instead of opportunity. Survival requires preserving both financial and mental resources. Most traders fail not because they lack opportunity, but because they experience a period of drawdown they cannot withstand. They abandon discipline, change methods, or increase risk in an attempt to escape discomfort. This reaction ends careers. The trader who survives understands that drawdowns are temporary, but breaking rules can be permanent. The goal of trading is not to win every day. It is to remain capable of trading tomorrow with clarity and confidence. This requires humility. It requires accepting that the market owes nothing. It requires controlling what can be controlled and respecting what cannot. Those who survive long enough begin to see consistency emerge. Experience compounds. Mistakes decrease. Emotional reactions soften. Survival creates the environment in which skill can grow. Without survival, talent is wasted. The market does not reward the boldest or the smartest. It rewards those who remain disciplined long enough for probability to work.